Have you ever daydreamed about starting your own company? What would that even look like? Well, today, that's exactly what we're going to do. We're going to build a business from the ground up, and we'll use the principles of corporate finance as our blueprint. Ready? Let's get started.
You know, it's pretty wild, but the entire massive field of corporate finance really just boils down to answering these three basic questions. First, what stuff should you buy? We're talking about the big-ticket items, the buildings, the machinery, the long-term assets. Second, how are you going to pay for all that? Is it coming out of your pocket? Are you getting partners? Or are you going to borrow the money? And third, the really crucial one, how are you going to manage the day-to-day cash flow? Collecting money from customers and paying your own bills on time. So, the questions themselves seem simple enough, right? But finding the answers, especially in a huge company, is incredibly complex. Which brings up the next logical question. Whose job is this anyway?
Well, in any large corporation, you'd meet the financial manager. This is the person or the team responsible for figuring all this out. And at the top of that pyramid, you'll almost always find the chief financial officer, or as you probably know them, the CFO. They're the key decision maker for pretty much everything related to the financial health of the company.
Now, the CFO doesn't do it all alone, of course. If you look at a typical org chart, you'll see the CFO oversees two really important roles. You've got the treasurer, who's in charge of those big financial decisions, the investing, the financing. Then you have the controller, who handles all the accounting, the taxes, the number crunching. For what we're talking about today, we're really focusing on the kinds of decisions the treasurer makes.
Okay, so remember those three questions from the beginning? Well, they're so important they actually have official names. They make up the financial manager's playbook, and they are capital budgeting, capital structure, and working capital management. Let's dig into what each one really means.
First up, capital budgeting. This is all about answering that first question. What should the business buy? A financial manager is always on the lookout for investment opportunities that are worth more than they cost to acquire. And here's a key idea in finance. It's not just about how much money an investment will make. It's also about when that money will come in and how risky or uncertain that payback really is.
Next is capital structure. I want you to picture the company as a pie. This decision is all about how you slice up that pie to pay for everything. What slice is funded by debt? That's money you've borrowed and have to pay back with interest. And what slice is funded by equity? That's money from the owners themselves. The specific mix you choose has a huge impact on both the riskiness and the total value of the company.
And finally, we have working capital management. This is the nitty-gritty, the day-to-day financial hustle. We're talking about managing short-term stuff like your cash on hand, your inventory, and also what you owe to suppliers. This might not sound as exciting as the big investments, but trust me, if you get this wrong, even a really profitable company can go bankrupt. It's that important.
Okay, so you've got the key decisions down. Now let's talk about the legal structure of your business. This choice is kind of like choosing your suit of armor. It determines how protected you are, how easy it is to get resources, and even how you get taxed.
So, here are the three main options. A sole proprietorship or a partnership. They're easy to set up, but they have one massive, terrifying risk: unlimited liability. That means if the business goes down, creditors can come after your personal assets, your house, your car, everything. And that's why almost any business of significant size becomes a corporation. It offers limited liability, but it comes with its own famous drawback: double taxation. The corporation pays taxes on its profits, and then the owners, the shareholders, get taxed again on the dividends they receive.
With all these decisions, structures, and trade-offs, it's easy to get a little lost in the weeds. So let's take a step back and ask the most important question of all. What's the point? What is the actual ultimate goal of all this financial management? Now, you might think the answer is obvious, something like maximize profits or maybe beat the competition. But all of these goals are actually flawed. Think about it. You could maximize sales by selling your product for $1. You could minimize costs by firing your entire R&D department. These might look good on paper for a single quarter, but they're terrible for the long-term health of the business and its owners. So the real goal, the one that financial professionals agree on, is this: to maximize the current value per share of the existing stock. It sounds a little technical, but it's a brilliant goal because it's not just about profit this year. It considers the long term, it accounts for risk, it wraps everything up into a single number that tells you how much the owner's stake is worth right now. Or to put it much more simply and bring back our favorite metaphor, the financial manager's job is to make the owner's slice of the pie as big and as valuable as humanly possible. That's the end game. But, and this is a big but, this leads to a pretty significant potential conflict.
You see, in a big corporation, the people who own the company, the shareholders, are usually not the same people running the company, the managers. And that separation creates something called the agency problem.
An agency relationship is simple. It's anytime one person, the principal, hires another person, the agent, to act on their behalf. So, in our corporate world, the stockholders are the principals. They hire managers to be their agents and run the company for them. The problem pops up when what the agent wants isn't exactly what the principal wants.
And you can see where this is going, right? The stockholders have a very clear goal: make their stock worth more. But a manager, they might be thinking about other things. Maybe their own job security. Or maybe they want to build a bigger corporate empire for the power and prestige. Or, hey, maybe they just want a fancier corporate jet. Those goals don't always line up with maximizing shareholder value.
So how do you solve this? How do you get managers to act like owners? Well, companies have a few tools. One is compensation, tying a manager's pay to the company's stock price through things like stock options. Another is control. Remember, shareholders can vote to fire the management team if they're not happy. And finally, there's the ever-present threat of a takeover. If managers let the stock price fall too low, another company might just come in, buy the whole thing, and fire them all. That's a powerful motivator.
And this chart really brings it all home, showing the entire cycle. A company goes to the financial markets to raise cash by selling stocks and bonds. It takes that cash and invests in assets. That's capital budgeting. Those assets hopefully generate even more cash. That cash is then either paid back to the investors or reinvested into the business to grow it even more. And the financial manager's job is to keep this whole engine running as smoothly and as profitably as possible.
So, that leaves us with one final and pretty deep question to think about. If a manager's number one job, their primary goal, is to make the owners as rich as possible, what happens when that goal clashes with the interests of other people? You know, like employees who want job security, or customers who want better products at lower prices, or society as a whole, which might want the company to be more environmentally responsible. It's the central tension of modern corporate finance, and there are no easy answers.